Joining us now, Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. We'll get to your, welcome, it's good to see you. We'll get to your specific sector switches and something you write called the pulse on the market. But let me just start with, you're pretty sanguine and bullish. Your 12-month, not year-end, 12-month price target is 81.50 on the S&P. It's a 10.8% gain from the June 25th close, where you say we froze our models.
We did. You have to pick
what does that mean? So you're not going to change this?
No. Well, we just have a rolling 12-month target. So we update it once a month. We refresh the models. Basically June 25th was the day that we went in and we froze the starting point, essentially, because a number of the models are based on a rate of return going forward.
So 10.8%. Some of the questions that I have about your sector switches, you're upgrading tech to overweight. So when did you go to market weight? Were you ever overweight? Because it's been the greatest performer.
Yeah, I've been overweight in the past. I mean, I've been neutral this year. And
all year.
Yeah, but you have to remember that comm services is a sector that has a lot of tech in it, and so we had preferred that area, and we're switching it up today.
So you're downgrading communication services to market weight. Did that work out, that move being market weight tech and overweight communication services?
Well, look, I think this is one of the things we've struggled with a little bit, right? Is that
it didn't work.
Well, we've had some concerns about the semis, and what I found in my recent marketing is that, the valuations have come down. I don't think that problem has been fully resolved. A lot of the hedge funds, it's come down enough for them, and so they want to move into the space. I think that if you kind of look at the different areas of opportunity in the market right now, comm services just doesn't feel like it's lining up to be the preferred growth area. For a long time, we had attractive valuations there, which we didn't have in the tech sector itself. We had strong earnings revision trends. We had pretty good flows. What we're finding now is that the tech sector actually has very strong flows. Now, there have been a week or two here of outflows, but they've bounced back pretty quickly. And on the valuation model, our technology sector broadly has kind of moved down. It's not quite at neutral, but it's really, really close. It's very, very slightly elevated. And that's come from dramatic improvement on the software side. And then we've also seen, kind of semis retreat a bit. I wish they'd retreated more, but it's been enough to get the model back to close to neutral.
Do any of these switches have to do with the earnings we'll see in the forecast in the next couple of weeks?
I think that's the other thing we're thinking a lot about is just the earnings trajectory, right? And the 81.50 target, doesn't seem that heroic, but you'd be amazed on the amount of pushback that we get.
What do you mean, from who?
I would say not so much the bottom-up equity crowd, because they understand the power of sort of the AI earnings story. But when we talk to more macro folks, we find we really have to walk them through what the bottom-up consensus numbers are looking at, how strong that AI story is compared to the rest of the market, and frankly, just how much of the weighting is in that AI story.
I mean, 20 times 400 on the S&P earnings is 8,000, so it doesn't seem like it's that hard to sell.
So, well, it's funny. We have a trailing model that we look at. We set it right now for 1Q27. We'll switch that over to 2Q7 after this reporting season. But when we walk through the numbers, we actually come up with a trailing PE of about 24.25, and we have macro inputs that go into that. So it's about 3% inflation we're baking in, one Fed hike, and then also looking at 10-year yields around 4.5%. And when I walk the macro crowd through that and say, we're getting some compression on that particular metric by baking in some very conservative, we think, macro inputs, they calm down a little bit.
Hey, Lori, just the idea that you are looking at 3% inflation, is there a chance that inflation runs even a little hotter because of the very strength you're talking about in AI? I mean, you look at the increases in inflation that's caused when it comes to construction, when it comes to energy prices, when it comes to chips, and how that's going to kind of work through the market.
I think that's fair, and we're starting to hear about that from clients as well. And I'll tell you, if you look at the consensus numbers for 2Q27, and we've written about this in our modeling, the numbers on consensus ratchet down to like 2.2% last I checked, and they're kind of penciling in 2.2% for the rest of the year. We had originally been baking in 3.3% in our May update for that inflation bogey for 1Q. And I pulled it down a little bit just when we got some of this de-escalation on the Iran war. We wanted to reflect, sort of that improvement in the gas price backdrop. But, I think our economists are maybe at 2.6% for 1Q.
Right, because the inflation is not just what we're seeing happen in energy prices because of the Middle East.
And we also have some tariff, kind of lingering impacts. We're going through kind of the worst of that at this moment in time, but we do still have some lingering impacts from that as well. So I wanted to pull the number down from where I was before, but I didn't want to pull it down too much.
Yeah.
You had been negative on consumer discretionary, so that goes to market weight. And then I feel bad for the utilities because you had market weight.
I know.
And you said we need an underweight. And so, I mean, so just because you need an underweight, the poor utilities need to be
in theory, I should
downgraded.
Probably have another underweight, something with bigger market cap. And we actually said that in the report. We thought about industrials, and we wrote this in the report.
They were ripe for a downgrade, but you're not doing it.
The problem with industrials is they are ridiculously overvalued if you look at things on a 30-year time horizon. If you look at them on a 5-year time horizon, they're not that bad. But this is the sector that sticks out like a sore thumb, and the market does not like things that are expensive right now, as we just saw with the semis, we saw with metal and mining earlier in the year, we saw with kind of the kind of Mag 7 type names before. Capital markets last year got stupidly overvalued. They're now down to average. But this market, it just wants to take things down that get too far ahead of them. Industrials are the candidate for that right now, and the flows are slowing, but the fundamentals are fabulous. So it was really a little bit of a struggle, but we did sort of flag that pressure, even though we didn't.
I think it's good that your macro people are uncomfortable with a 10% forecast for 12 months. So they're not complacent.
So, what's funny, if you look at the AAII survey, we've been sort of hovering in this, kind of average to one standard deviation below average range. That actually generates a 10.8% return over the next 12 months. And, we get all these questions from the macro crowd. Well, look at where things are trading. You're not reacting enough to the Middle East. Equities seem, kind of crazily frothy. And I'm like, well, I'm not hearing it in my conversations, right? I'm not seeing it in the data. And yes, there have been some valuation
They would have
problems.
been out of the market for the last year if every time something that was staring them in the face made them nervous. So they probably were.
Right. And what we try to do with the price target, we call it a compass, not a GPS, but we try to look at a variety of perspectives. So we have a Fed model, a GDP model, a valuation earnings test, a cross-asset test. And I talked about the, kind of sentiment and valuation and earnings dynamics. And those range, again, based on the June 25th, the lowest one was GDP 77.77. So we said, if you're really kind of dour on the economy, sure, we can get you there. But what we've done with that valuation earnings model in particular is we've done stress tests for people. And what we show them is that if you really want to get bearish on the market, you have to get bearish on earnings. It's not just enough to be worried about valuation pressures. And you have to attack that AI earnings story. We take the consensus down by 5%, and we're still getting to 81.62 on that model. And so that's what we're really trying to show people with that is we can take all your worries and we can put them into the model, but we're not going to kill earnings, and we can still get you decently higher.
I was trying to think of what would be the biggest, fly in the ointment for this whole scenario, and you said it's mostly based on earnings, so then we'd have to find something that would affect earnings. I guess if the war really got out of control and inflation.
If one of the big mega spenders said all of a sudden that they were going to cut back spending in a big way.
Right, and there's a lot of worries about that, but when you actually go and talk to our analysts, it's hard to find concrete things to point to.
Well,